Hi, I'm Rand Westland with the next installment in our series, The Quest for Normalcy, the continuing saga of an economy seeking normalcy. Our ongoing conclusion, less worse has become more better. Pain is turning into gain, slowly, and the wrenching experience of recession and the panic of 2008 reset minds to be vigilant, conservative, and reasonable in expectations and decision-making. These conditions stunt growth, but the seeds of this subdued economic growth, called the new normal by some, were sown over many years. Now we reap what is sown. The Federal Reserve is famously in a pause mode, holding short-term interest rates very low, yet other economic elements are in a like mode, creating what I call the land of pause. First, consider a long-run chart of interest rates. Looking back over the last 30 years, we see rates have followed an undulating pattern downward from extraordinarily high levels to historically low levels. The general decline in rates gave a tailwind to the attractiveness of using other people's money. However, the law of diminishing returns brought us to a point where additional borrowing was generally unsupportable, regardless of rate level. The collective and individual balance sheets could not handle it, and the debt spree paused. Next, consider a long-run chart of housing supply. The general rate decline underwrote more options to become a homeowner, house investor, house builder, etc. But the virtuous circle, following rates to rising house prices to more building, generated a more than doubling of the supply of houses for sale from 2000 to 2008. And then there were too many. The building boom oversupplied houses versus the number of home seekers. This surplus also uncovered the sad reality that many who borrowed to buy a house priced too high could not afford to keep that house, nor could they sell it to someone else. The former price rise turned into declines nationwide, sparked turmoil throughout, and the building and swapping of houses paused. Now consider a long-run picture of employment factors. The strong 1990s economy pulled people into the labor force, put more of them to work, and even took unemployment below a level long considered a threshold. But the trends changed course into the 2000s. The labor ratio reversed as the population aged, and productivity enhancements reduced the number of workers needed per task. Do you realize that the Department of Labor estimates an average 1999 employee completed in 40 hours what now takes about 30 hours? Further, extraordinary job creation in the financial and construction industries accompanied the expanding demands, but the combination of the pauses halted that job machine. These broad trends were already in place when the panic forced companies to shed costs, caused a spike in unemployment, and declines in labor ratio and the employed. We covered the panic of 2008 in an earlier webcast and believe the panic accelerated the confluence of these pauses that were coming anyway. The stresses elicited cries for government intervention. Extraordinary actions to quell the panic generally worked, while also raising the level of debt and deficits and leaving little room for more action to spur growth. However, the actions taken suggested that more regulation and more taxation are coming to cover the commitments made. Unintended consequences of government action can take a long time to surface and will likely add to the pause effect throughout the economy. So, now we find ourselves wandering in the land of pause, and much commentary revolves around how to escape its grasp. Despite the apparent return of economic growth, the investment world seems upside down. In this place, the safest asset, cash, has no yield and plenty of holders. Bonds pay historically low yields and face imminent value decline when interest rates begin to rise, yet find investors rushing in. Stocks, usually purchased to participate in the long-term growth and the value of the underlying entity, seem to have disconnected from those very entities in a rapid scramble to chase or flee short-term price changes. Obviously, the land of pause is not a normal place, but its conditions will produce benefits. For example, I believe a key reason interest rates remain extraordinarily low is cash holders seeking a place to park that cash. Consumers ratchet back their debt use and increase savings. Debt payments, falling in ratio to income, approach the average level of the last 30 years. Although short of historical averages, savings are climbing as spending grows more slowly than income. Corporations learn from the recent stressful years to strengthen balance sheets, streamline operations, and grow cash flows. Hesitant to expand operations, they also park a growing amount of cash. Plus, troubled global investors have fled to high-quality U.S. Treasuries. Combined, these key factors produce cash and suppress interest rates, but also pave the way to exit the land of pause. However, this exit will not come without some pain. The U.S. retains great potential to be a manufacturing powerhouse once again. The nation's infrastructure offers a strong foundation, yet we presently suffer from a surfeit of unemployed workers and meager job creation. A growing employer complaint is that many potential employees are ill-equipped to handle today's higher-skilled processes. Further, given a choice, most people would prefer to find a job where they live rather than move. Yet technological advancements have altered the skills needed and increased the mobility required of workers, an element hampered by the present state of affairs in the housing markets. The beauty of capitalism is its ability to adapt. But how long does it take to grow a skilled worker? Perhaps years, unless the core competencies in the available worker pool can be leveraged with new knowledge and training. As the baby boom generation enters its retirement age, addressing the mismatch of employer needs and prospective employee skills can maximize the potential to help us exit the land of pause. Meanwhile, what is an investor to do? Foremost, recognize that risk in the land of pause is also upside down. Risk is not just the near-term volatility of price changes. Risk includes the loss of real value. Cash and bonds offer little yield and no protection against the even low erosion of inflation, meaning their future value is threatened. Comparatively, conditions in the land of pause greatly enhance the real future value of many high-quality, globally focused companies. Though skepticism abounds, analysts are raising earnings estimates for 2010 and beyond as companies benefit from these conditions, a promising development. A core mix of holdings featuring global powerhouses like Procter & Gamble, Intel, or General Electric offer attractive current income and the prospect for investment value and dividend growth to follow earnings growth. Selling at valuations comparable to their weaker brethren, such companies grant investors solid choices in which to invest during this wandering in the land of pause. The old question reads, how far into the woods can you go? Halfway, for then you are on your way out. I believe the same holds true for the land of pause. We are wandering somewhere in its middle and, perhaps, beginning the trek out. Consumers will increase activity as they become more comfortable in their financial positions. Corporations will expand and hire as they see the need to put their cash hoard to work. In time, the sum of these decisions will foster greater growth and lead us out of the land of pause. Thanks for listening in. Have a great day.